Good afternoon, everyone, and thank you for joining us today. I trust you're all keeping well. My name is Vito Dintrono. I'm Yarra Capital Management's Chief Commercial Officer. I'm delighted to welcome you this afternoon's webinar with Tim Toohey, our Head of Macro and Strategy. Very shortly, Tim's going to take us through a presentation covering the impact of the early access to super provisions which have been enacted by the government to soften the impact of COVID-19. Tim will also touch on the impact of freezing the super levy. The numbers we talk to today are quite staggering. When the early access plans were first introduced, the government estimated there would be up to $27 billion withdrawn from super accounts, which is less than 1% of the total system. As at mid-August, that had been exceeded, with the government now expecting up to $42 billion to be withdrawn, and some industry leaders believing that that number will be closer to $50 billion, or almost twice the initial estimate. So plenty for us to ponder. Before we get started though, just some housekeeping items. Firstly, you're listening to this webinar using a computer speaker system by default, and all participants are in listen-only mode. You'll have the opportunity, I should say, to ask questions at any time during this session just by typing them into the question pane of the control panel, and we'll look to address as many questions as we can at the end of today's formal presentation. As ever, we'll aim to wrap up a little after 3:30, but for now I'd like to hand over to Tim. Thanks, Tim.
Thank you, Vito, and thanks everyone for joining us this afternoon. Look, I'm just going to dive straight into it. So slide 3 of the presentation pack has the latest APRA data. Now, as Vito just indicated, we are well and truly above where the Treasury had initially estimated voluntary super withdrawals would get to, and we are on track to move towards something that looks close enough to 50 billion. By calendar year end. There are some important aspects around what's been going on, not least being that 1.2 million of the applicants are repeat applicants, so withdrawing in excess of $14,000 from their superannuation balances. So let's have a look at two aspects of this. First of all, what has been the macroeconomic impact of the voluntary super withdrawals? What benefit has it actually provided to the economy? And secondly, let's look at what the potential damage the withdrawals have done to the individual's lifetime savings. Firstly, you can see on slide 4, hopefully this is a familiar chart to you because we've used this chart updated and extended in different ways through these webinars since they first began and in some of our research reports. The point on this chart is really trying to look at the various government programs combined with the voluntary super withdrawals, mapped up against the labour income declines that we would likely see through the advent of COVID. The red line is really the line to focus on in many ways because that describes the net income benefit to the household. And as I think we've seen quite clearly in yesterday's national accounts data and in recent months' retail sales data and company reports, just how much excess stimulus was there that the household benefited from and spent in terms of in areas of retail sales and durable goods. What's clear about this chart is that the voluntary super withdrawals described by the black bars are likely to be actually the dominant form of stimulus, keeping household cash flows positive in net terms through the back end of this year. Of course, we then migrate to the, in terms of the yellow bar, to the potential impacts of the income tax cuts, which no doubt we'll talk about at some point. We could see quite clearly on slide 5 that perhaps one of the more surprising aspects about the size of the stimulus is that in the advent of such a sharp deterioration in economic activity and such a large fall in nominal consumption growth, that household income growth actually expanded. In fact, it's running at its fastest in 9 years. And there's never been such a large divergence between realised income and actual consumption levels. The implications of this, of course, is that household savings have exploded. This is not household savings in terms of like a superannuation account. It's household savings in terms of how much you're consuming out of income relative to each period. So what is very clear from this chart is that the policies that were put in place were designed for a much larger economic downturn and financial wealth hit than is what actually has transpired. And it's more true in terms of the financial hit. There is normally a proportional and inverse relationship between declines in wealth and lifts in the savings rate as people try and repair, if you like, their gearing ratio. But the decline in wealth this time around, relative to the size and the spike in the savings rate, is without peer. So clearly it's good news in the sense that the voluntary super withdrawals are part of that story, and they will enable households to run down those savings levels through the balance of this year and indeed into 2021 as well, and help facilitate the recovery. It's also true, as a bit of a segue, perhaps on slide 7, that we've never seen such a large fall in the things you actually have to spend your money on. So areas like discretionary health expenditure, operation and motor vehicles, and of course the RBA has helped, and interest rate expense has declined as well. So we've had the largest fall in non-discretionary cash expenses. So the combination of very large fiscal stimulus, voluntary super withdrawals, declines in areas you don't have to spend your money on has freed up cash flow. And we've seen on slide 8, who the clear beneficiaries of all this really were, areas like furniture sales, electrical goods sales, hardware sales, sporting goods sales, and of course alcohol consumption have surged. Now, not all of this is the voluntary super, but we can isolate the impacts of voluntary super and what that money was spent on from a slightly different survey. Slide 9 looks at the Ilion and Alpha Beta data set that many of you may be familiar with, that is attempting to use a survey of around 13,000 people to isolate how they spent the super that they withdrew from rounds 1 and rounds 2, and which buckets the money went to. Without wanting to make too many motherhood type statements, it is notable that, for example, that as much was spent on online gambling as groceries in round 1. And indeed in round 2, online gambling didn't really fall that much either. So some of this is genuine need, some of this is obviously well targeted, some of the members clearly have a strong economic rationale to make the voluntary withdrawals. But as slide 10 summarises, almost 2/3 of the voluntary withdrawals have gone towards discretionary spending. And at the very least, it's showing us that in the absence of mandated savings, households have a very strong revealed preference that they would choose to consume today over the thinking about their longer term retirement savings. So let's think about what impact the voluntary withdrawals would do to an individual's lifetime savings under different scenarios. Slide 11 is a little bit of a messy chart, but it's just running 4 different scenarios for a household with the wage earner earning $86,000 today at age 30, with some modest real wage gains over the period, with a starting superannuation balance at 30K, and assuming 4% real returns on investments on that portfolio over the duration of his retirement, of his working life. So there's a couple of points to make here. The first of all, we can see that there is a very large difference between the scenarios where an individual remains at 9.5% in terms of the superannuation levy. There is a modest difference between whether the individual gets a compensating wage increase for the levy not increasing over the transition period to 12%. But there is an enormous difference between when an individual who takes $14,000 out in 2020 doesn't replace that in subsequent years, and the levy stays at 9.5% relative to the prior case, where you couldn't have removed $14,000 per annum and the levy increased to 12% by July 2025. As you can see on the next slide, where we summarise those outcomes a little bit clearer, a 30-year-old would be at least $102,000 worse off upon retirement by withdrawing the $14,000 today under those assumptions. And we're doing this in nominal terms. If the levy was also frozen at 9.5% rather than escalating to 12%, and the individual had taken out $14,000 today, that same individual would be up to $400,000 worth off upon retirement. So these are really large numbers. Where all the debate has really focused, though, through most of the deliberation into this retirement income review, which is a 650-page report sitting on the Prime Minister's desk, yet to be released, seems to be on whether households would get an offsetting wage increase in lieu of the levy not increasing to 12%. I think there's a couple of problems with the way people have modelled this out in various ways, both empirically and both logically. But the starting point is it's not an increase in wages into perpetuity. The increase in wages would only occur during the transition phase from 9.5 to 12%. And hence the impacts on lifetime savings are not overly large, particularly not overly large in comparison to the green and the yellow bar under those scenarios. So we think it's quite a big deal, and it's not an exercise we'd like to repeat year in, year out, every time there's an economic bump on the road. The ongoing damage that is done just from a single exercise is large enough. Repeat experiences would not only undermine the individual's outcome, but potentially the systems. Slide 13 flips the analysis around, where we try and model the impact on net flows into the superannuation system in total. Now, modelling all the intricacies of the superannuation system is not an easy thing, and we've seen many academics and lobby groups attempt this in different ways. So I'm drawing upon prior research that I've done over the years and updating it for the most recent data and for the policy proposals that are currently on the table. First point that you can see from the historical data in the chart is that the voluntary super withdrawals, combined with a relatively poor investment return outcome for the year 2020, it was somewhat of the inverse of what happened during the last phase of the Howard government's incentivisation to increase voluntary superannuation during that 2007-8 period. This is where you could put up to $1 million in voluntary contributions as a single lump sum, and a further $1 million if you're a small business owner. So we've essentially done the reverse of that exercise. First point is that if the superannuation levy stays at 9.5% and doesn't move up as is currently legislated, under the assumptions that we're using, and I'll quickly run through the assumptions in a second, it's feasible that the net flows into super will actually turn negative in just over the next 10 years. So the assumptions we're using is we're really using the demographic structure of the population year by year as stipulated by the ABS Series C. Now the Series C scenario is the one that is much lower net migration assumptions in the forward period and lower population growth, which we think is now the more realistic scenario out of the population models that are out there. And hence, in that regard, it's probably a more accurate reflection of how we should be thinking about superannuation balances going forward. We are assuming a replacement rate of final income of around 60%, and we assume it declines through time as assets outside super expand. We're assuming the investment returns are set at 5% per annum during the projection period, and we're assuming again that you do get some modest wage increases during the transition phase modest wage decreases during the transition phase to 12% superannuation levy, although that in itself is debatable. So the core point here is that relative to that scenario staying at 9.5% versus moving to a scenario of the legislated 12% gives a very, very different outcome for the superannuation system in net. The system is incredibly sensitive to the assumptions, and I think anyone that's tried to model superannuation through time would recognise that. It's clear from recent media reports and statements that the government is considering either a temporary deferral of the escalation in super levy and potentially a lower target high point. Here, in terms of the black line and the projection period, we've assumed that the levy is frozen at 9.5% for a further 3 years and then finishes at 10.5% in the subsequent 2 years. Even under that scenario, it would take the net flows into the superannuation perilously close to being into outflow. And of course, if we go through a period of ongoing voluntary super withdrawals, it would clearly tip the system into it. So this is a really important time for the superannuation industry, not just in terms of thinking through the defence as to why Australia needs a superannuation industry, but also the defence of doing repeated exercises what we've just done. And we'll talk through some of this in a moment. So what are the key points so far? Well, first of all, the voluntary super withdrawals has been a very important factor bolstering household income through the June, September, and will be the December quarter as well. Thus far, it adds up to about 2.5% of household disposable income, and that's obviously a lot. And on our projections for the remainder of 2020, voluntary withdrawals will equate to 4% of disposable income in the year. Not all of this has gone into areas that are probably that desirable, and it's clear that 64% of it has gone into areas that would clearly be labelled as discretionary. It's also quite clear that households have demonstrated that in the absence of compulsory savings, they would clearly choose to consume today rather than save for the future. We've looked at the impacts of the different scenarios, but clearly withdrawing 14,000 in 2020 would have a significant impact on a 30-year-old's final superannuation balance. We estimate about 102,000. It gets a lot worse if the superannuation levy doesn't go up to its scheduled 12%. So the opportunity cost is large for the individual. We've articulated that by whether households get an offsetting wage increase or not during the transition phase of 12% isn't really the biggest issue facing the industry at the moment, yet it seems to be dominating the debate, both at an academic level and at a policy level. And of course, we've just looked at, in terms of the prior chart, the impacts of what the system level would be under those various scenarios. So on slide 15, we've encountered a number of arguments, or seen a number of arguments that have been put forward as to why we should pause the increase in the super levy. And the four major ones that I can see, at least, are detailed on this page. And I think there are some responses that are worth acknowledging. Of course, this retirement income review that we're yet to see will delve into some of these issues. And Treasury certainly has a strong interest in ensuring that it can address its tax revenue position over the forward period. So we would hope it's going to be an evenly balanced discussion. But as with everything, it's when you get down to the modelling, it really comes down to the assumptions that you're using and the techniques. And the biggest one that seems to, the biggest argument against the increase in the super levy is that, well, wage growth has been slow, and lifting the levy will only suppress wage growth further. And workers need that boost in income now, not in 20 or 30 years. And we've seen that argument filter through from different lobby groups into the mouths of politicians through time. But there isn't a guarantee that a flat levy will result in stronger wages growth. Now, I've spent a long time trying to model wages, both here and overseas, using different frameworks and looking at the evolution of the modelling techniques that are out there. And this has been one of the great conundrums of the last decade and a half. Why have wages remained as weak as they have into tightening labour markets or falling unemployment rate environments? Now, we're all familiar with the concept that, well, maybe that just means that the full employment level has moved lower. But quite simply, just about every major wage model that I've seen would suggest that whilst there is spare capacity in the labour market, an employee is unlikely to see an increase in wage rates. Now, that is going to be the economic reality for most Australians over the course of the next 5 years. And identifying the reasons for weak wages growth is not unique to Australia. This has been an ongoing search across all the developed nations, and it has really heightened over the last 5 years or so as the central banks have become increasingly involved in the search. The most prospective reason for why wages have remained as weak is that if you think about wages through the life of or working life of an individual, when you're in the first trimester of your working career, your wage increases are relatively modest. Wages tend to go up quite a lot during your middle trimester, where you're reaching peak skill, if you like, and peak effectiveness in your organisation, perhaps, and they tend to stabilise in the last trimester. When you have the baby boomers at the last trimester, essentially, and the millennials in the first trimester, the really big bulges in the population structure, it gives you actually lower wages on average. And the academic research that has been available in the US and research that I've done locally suggested that adds up to about 2.7% of wages per annum. And that's a much bigger deal than what we're talking about in terms of the outcomes coming from a freeze in superannuation levies or not. Indeed, the models that we've seen trying to explain weak wages by an increase in the super levy explain less than half of the movement in wages, even in their tighter specifications. Whereas models that include the demographic structure that we're talking about explain closer to 80% and well north of 3/4 of the movement in wages quarter to quarter. So we would contest that the model that you're using is super important. And again, where you have ongoing spare labour capacity, there is very little incentive, both from a theoretical and from a practical point of view, for an employer to give that employee an increase in wages in lieu of not increasing the super levy. There's also an argument that's put forward that given the interaction of the pensions with the superannuation system, that because most people will be drawing a part pension during the retirement phase, that increasing the superannuation levy will only lead to lower wages during the working phase, and therefore a lower take-off level for the pension upon retirement. Again, this just merely assumes the same argument in under point 1. There's an implicit assumption that an increase in the levy generates lower wages for households into perpetuity, not just during the transition phase. So again, there is a case against that. And there's also the more obvious point that we've moved away from setting pensions in line with average weekly earnings growth. Pensions are now indexed to the higher of the pension and beneficiary living cost index, so costs that are associated with people that are in retirement, or the CPI. And in the current year, where those prices have fallen, they're not even getting that. It's been frozen. There's also the argument that assets outside of super should be included in the assessment of whether the levy should be increased. And once outside assets are included, most households have an adequate retirement income. There's some truth in this, but the distribution of wealth is heavily skewed to high income earners, and to obviously the housing wealth. So in the absence of a very deep and accessible reverse mortgage market and the social issues of enforcing people to liquidate their primary asset of a house and then rent, then there are elements of that base assumption that are simply impractical, both from an implementation and from a political perspective. And perhaps lastly, there's a general view, and again, this should be updated in the retirement review, that the superannuation tax concessions exceed the benefit to the government of lower pension payments through time. Well, the response is maybe. The last time Treasury actually provided an updated estimate of that was 2013. So the assumptions clearly need revisiting. And even at that time, the pension rules have been altered. The asset returns have clearly been higher within the superannuation system than was assumed. And the Treasury modelling assumed that we would already be at 12% by 2020. And of course, we are not. There are also some missing arguments that I think the superannuation industry could do well to acknowledge in its defence. Slide 16 is two of them. And perhaps they are already doing number one, if I tune in and see Greg Combet advertisement from the television from night to night. But it's quite clear that the central bank, the government, at all levels really, acknowledge that we need increased investment in general and increased infrastructure investment in particular as one of the keys to unlocking productivity growth and higher living standards through time. But we've been locked in this prisoner's dilemma for the last 20 odd years, where the federal government has tried to incentivise the states, and the RBA have also tried to browbeat all participants that an increase in infrastructure investment is actually required, yet the states who control the vast majority of infrastructure spending are just reluctant to borrow such large-scale and multi-jurisdictional projects. And as such, will lead to some suboptimal capital allocations. We've also got an issue in the sense that private capital markets don't really reward long duration projects themselves. So the equity market is not necessarily going to be the place that really rewards long and dangerous, or if you like, risky projects during the construction and early implementation phase. Superannuation funds are one of the very few entities that have the scale, balance sheet and investment horizon to back those projects outside of the resources sector. So I think to a degree that is understood, but the case could be made much better than what is the alternative. Point two is perhaps one that's not stated, and I think it's actually the most important. So in the absence of the superannuation industry's diversification of assets offshore, it's highly likely that the Australian dollar would be materially higher. And as such, broader financial conditions would be materially tighter, and as direct causation, economic growth materially weaker than that would otherwise have been the case. You can see in the left-hand side chart at the bottom just the historical relationship between movements in the Australian dollar and the terms of trade. So commodity prices have largely determined that story. We have diverged in recent years from the broad trends of the terms of trade and the outcomes of the A dollar. And I've written upon this numerous times, but the core reason for that divergence is actually on the right-hand side chart. It's that weight that's been provided by portfolio outflow out of the country, largely via the superannuation industry investing in assets offshore, that has helped being the counterbalance for commodity prices in particular that would have driven the currency to much, much higher levels and much weaker economic activity than perhaps we would have seen in its absence. Slide 17 is a related but different argument. There's also the diversification benefits that that's actually providing. It's not just keeping the A dollar lower, it's helped transform Australia from a position of being a net payer of dividends to offshore investors to being a net recipient. And we've only really just moved in the last couple of years into that net positive position. But it's a very important position to be in. It adds a sense of economic insurance or a buffer to the revenue streams into retirement and beyond for the Australian economy. And perhaps finally on slide 18, the other, I think, obvious point that could be made much stronger is that superannuation assets are providing the really critical buffer against the economic vulnerability in Australia of high household debt. Now, we know that in the absence of periods of where we've seen large declines in house prices, we have seen larger economic contractions in the past when superannuation assets were at a lower level. It's the fact that superannuation assets aren't levered, whereas a lot of the other private assets, leverage is involved, that helps provide that really crucial buffer for not for the broader economy. It's why we don't see households aggressively altering their spending patterns during the last couple of house price decline cycles relative to what we saw, say, in the early 1990s. So I think the superannuation industry is incredibly important in playing that role and helping to facilitate, again, the lifestyle and the non-superannuation asset growth that we've seen off the back of it. So I'll probably conclude there and hand back to Vito and see if we have any questions.
Great. Thank you, Tim. Yes, we have got time for a couple of questions, and thank you to all of you that have submitted questions. Tim, the first one's a two-part question. Firstly, what are your thoughts more broadly on the impact of super funds on asset allocation? And secondly, what do you think ERS does to the forward-looking return profile for super funds over the next 3 to 5 years?
Yeah, well, thanks, Vito. Look, I think the reason why I put in the chart for that showed the net drawdown in super through time and how that's been brought forward by the voluntary super withdrawals helps illustrate the answer. The first part is that it forces a shift in the asset mix that you would probably normally want to do. You are forced to be more liquid. You are forced to be in more traditional, if you like, equity and bond type products, both of which are trading at very high valuations. And it takes away that optionality of investing in the very long run, which is probably the sweetest spot to be in that can help generate the society-wide benefits of broader productivity growth. So I think that needs to be thought through very, very carefully and articulated back to the superannuation members very carefully.
Okay, the next question, Tim, is the numbers on early release are large in absolute terms, but still quite small in terms of total system. Are we perhaps at risk of blowing the impact on the super industry out of all proportion?
Yeah, I don't think so, Vito. I think this is an incredibly important period. There's always been great debate about what would happen at what point at the point of when the superannuation system moved into net withdrawal mode, and I think the prospect of what we've done in the last few months being a source of a new policy arm for governments is a very dangerous thing to do, because it'll undermine both the incentives for being in super for a long period of time, because even if I have no intention of doing voluntary withdrawals myself, I know that it's impacting the superannuation fund I'm invested in terms of the decisions they can make, and that's going to have a detrimental impact on my retirement savings. So even if you want to argue that this is a one-off and it's a relatively small amount and it will repair itself in time, you need to be very clear that it's not something that will be an ongoing feature of government policy at a whim, because this one has proven to be such a windfall for households in a short period of time. So there's that component to it, and there's also the component of we're not sure that during an asset redemption phase, what people will be doing. Does that also alter the voluntary contributions of people going on a go-forward basis as well? Why would you be contributing into a superannuation system when you know that superannuation system is in runoff? Is one of the questions. So I think it's not a case of being, if you like, confident that this is a small event and will blow over in time. I think this is a very important point to clearly articulate the benefits of the super system to the members and to broader participants in the economy.
Great, thanks, Tim. Conscious of time, but let's slip one more question in. Tim, you were pretty early on in suggesting that the government would move to pull forward tax cuts to stimulate activity. Any update on the view of either quantum, timing, or impact of that pull forward?
Well, thanks, Peter. That's a bit of a layup, isn't it? Well, it was all over the newspapers this morning, wasn't it? With the Treasurer acknowledging that the budget, which is now scheduled for October 6th, will certainly be entertaining the pull forward. You probably saw in the second slide too that our assumptions there for the income tax pull forward. So the large increments come in two different phases, and what we've done in our assumptions was assume that the first increment, which was done over two budgets, is pulled forward from the start of calendar year 21. So the timing of the budget in October is of particular interest because it does open up the possibility of going from the first of the calendar year rather than waiting for the 1st of July. And I think putting it out there at this time of the year is clearly an entree for that. It seems as though the government, at least in terms of discussion in the paper today, that they're still really debating whether to bring forward all phases of the various tax promises. The core thing to bear in mind is that they already paid for, and the additional cost of the budget will only be in the bring forward of a couple of years, which is not, in the scheme of what we've done in the last 6 months, is actually rather trivial in terms of the additional cost. It's very important. It's different from one-off handouts. There's a concept in economics called Ricardian equivalence. When the government gives you money, you might not spend all of it because you're worried that they're going to tax you on the other side. But when you're actually delivering a permanent tax cut, it'll have more far-reaching and more meaningful impacts, I think, on broader consumption and savings rates through time. So it's a very important initiative. It will help knock the edges off as we come off the sugar hit from the initial payments and the initial release of economic activity, or the upspurt in activity we'll get at the end of the year as mobility increases. It'll knock the edges off sliding off the back of that as we move through the course of 2021. But as you can see from that second chart, in and of itself, it's not as large as what we've just done in terms of the various fiscal payments and the voluntary withdrawals from super.
Great, thank you, Tim. Very conscious of time, so we might leave it there for today. There's still a number of questions in the queue, so we'll look to address those individually in upcoming days. Just a gentle reminder to keep an eye out for an invitation that should land in your inbox in the next day or so, featuring next Thursday's webinar, a post-reporting season webinar featuring Dion Hershen, Katie Hudson and Joel Fleming, so keep an eye for that, please. If there's any questions with regards to today's session or any broader Yarra-related questions, please contact myself, Nick Green or Amala Kotian in the first instance, and more than happy to help out or arrange a discussion with the various team members. Post today, you receive a survey in your inbox. Any feedback with regards to today's webinar or any other feedback, greatly appreciated. Happy to take that on board. And then really finally, on behalf of Yarra Capital Management, a massive thank you for joining us today and for your ongoing support. Thank you and have a great afternoon. Bye-bye.